Modern investing happens in front of screens, live prices, flashing charts, constant notifications. Yet some investors choose a radically different approach. They invest, close the screen, and continue living. This behavior reflects not indifference, but psychological discipline. It represents a long-term mindset rooted in emotional control and strategic clarity. 2. The psychology of constant monitoring. Research in behavioral finance shows that frequent portfolio checking increases stress and emotional reactivity. Psychologist Daniel Kahneman demonstrated that humans are highly sensitive to losses. The more often investors check prices, the more often they experience small losses, even within normal volatility. This phenomenon is known as myopic loss aversion. Short-term losses feel amplified when observed frequently. Closing the screen reduces this psychological noise. 3. Emotional discipline and self-regulation. The investor who closes the screen practices emotional regulation, delayed gratification, reduced impulsivity. Emotional intelligence research popularized by Daniel Goleman highlights the importance of managing reactions rather than eliminating emotions. Closing the screen is not avoidance. It is boundary setting. 4. Long-term thinking. Legendary investor Warren Buffett is known for a long-term philosophy. Buy quality assets and hold them patiently. His approach reflects a core principle. The stock market transfers money from the impatient to the patient. The screen-closing investor embodies this patience. Instead of reacting to every fluctuation, they trust their strategy. 5. Cognitive benefits. Reducing screen exposure leads to lower stress hormones, fewer impulsive trades, better decision quality, stronger focus on real-life productivity. Attention is a limited resource. Constant monitoring drains cognitive energy. By closing the screen, the investor reallocates attention to career, health, relationships, and growth. 6. Strategic versus avoidant behavior. It is important to distinguish between strategic detachment neglect, based on long-term plan based on fear or denial, periodic review no review at all, informed confidence ignorance, controlled monitoring complete disengagement. The healthy investor sets review intervals, monthly or quarterly, rather than reacting daily. 7. Identity shift, investor versus trader. Screen-closing investors often see themselves as owners of businesses, long-term capital allocators, wealth builders, not as daily traders, chart watchers, emotional speculators. This identity shift changes behavior dramatically. 8. Philosophical dimension. Philosophically, closing the screen reflects acceptance of uncertainty. Markets are unpredictable in the short term. Attempting to control every movement creates illusion rather than mastery. Detachment becomes a form of strength. 9. Conclusion. The investor who closes the screen and moves on with life demonstrates emotional maturity, strategic clarity, patience, trust in process. Success in investing is not only about analysis. It is about managing attention and emotion. Sometimes the strongest move in the market is turning it off.